we're diving deep into a ticking time bomb in the financial world. A staggering $1.5 trillion in commercial loans are about to mature. They're about to come due, meaning they have to be paid off. And with today's high interest rates, many borrowers face a harsh and brutal reality. They simply can't refinance. This looming crisis threatens to unleash a wave of loan defaults and commercial property foreclosures. But here's a twist. While this may sound like a disaster, this crisis also represents unique opportunities for the savvy investor. I'm going to break down what's happening today with commercial loans, and I'll share with you why it's happening. It's very important that you understand this, and most importantly, I'll share with you how you can profit from the upcoming chaos. Let's get started. All right, let's get started. I'm going to share with you one thing before I do get started. What's happening in commercial loans is to allow me to help you distinguish between a residential loan and a commercial loan. Okay, a residential loan is a home, a fourplex, triplex, things like that, and the loans are usually amortized and will be 30 years, 30-year fixed loan. So yeah, you can just hold on to this loan for 30 straight years and be fine. In the commercial world, that's not the case. In commercial loan, we may have the loan amortized over 15, 20, 25 years, but it matures in 5, 7, or 10 years. That means when it matures, the bank wants their money, they want to get out. And the reason why the bank wants to get out is because they don't want to be committed to that building or that community for 30 years. They want a chance to reassess the loan before they go back in. Okay, so the main difference is in residential, you have a 30-year fixed, and then in commercial, we may be amortized over 25 years, but the loan is due in 5, 7, or 10 years. Got it? Okay. Now, let me share with you what's happening with commercial loans today. I can sum it up in one sentence. Here's a sentence. We are hitting a maturity wall. Okay, maturity wall. Here's a definition. A maturity wall is significant volume of commercial loans reaching their maturity date, okay, 5, 7, to 10 years, within a short period of time. That means these loans that were originated 5, 7, 10 years ago are now about to expire, and these loans must be paid off or refinanced. So right now, the ticking time bomb is right now, within a few years, $1.5 million is coming due. Okay, so when I say ticking time bomb, this $1.5 trillion is a ticking time bomb. Next, now let me just make it simple for you, just for 2025, okay? Just for 2025 only, here is maturity wall as follows, and I'll just go over with you multifamily, office, and retail, all right? So between multifamily loans coming due, office, and retail in 2025, meaning in 2025, these borrowers, these investors, their loans are due. They have to refinance. In 2025, it totals to be about $534 billion, right? Not all of this is going to be able to be refinanced. Some of this is going to go back to the bank. Some of it will, the loans will be worked out, or they're going to have to sell their property. There will be some distress here. The breakdown is for 2025, there's about $257 billion in loans coming due. For the office, this is the most troubling asset, the most distressed asset. $206 billion are coming due in 2025. And for retail, also a troubled asset, that's about, and this is no small figure, $71 billion coming due. So there's going to be massive opportunities in these three assets because of the ticking time bomb. Got it? All right. Click subscribe and add alerts so you can get more easy to understand commercial and multifamily wisdom. I just went over with you what's happening. Now let me share with you why it's happening. You really have to understand this. Let's do that next. Let's start off here with why. I'm going to give you two quick examples of why this is happening. Okay, and then right after that, I will jump into to prove why it's happening mathematically. Let's do this first. Here's the first examples. 145 Southwest Office Tower. It's a 20-story office building. I'll show you pictures. There was a loan involved about $57 million. Okay, It was built in January 2020, around the pandemic time, right? Poor timing. Interest rates were 3.1% back then. The pandemic caused high vacancy. Everyone's working from home, low demand, so the property was not making any money. So the net operating income was very low, if any, right? And in 2024, when it was time to refinance this loan right here, interest rates were 7%. So impossible. So it foreclosed on in July of 2024. And the reason why, high interest rates and a very low net operating income. The bank said no, your property does not cannot afford a loan in the amount of 57 million, so you have to foreclose. Okay, example number one. Example number two was a very large multifamily company by the name of Tides Equities. They've owned over 100 properties in the Southwest. There's pictures of the properties right here I'll show throughout. And in 2024, a dozen or so of their properties were enter foreclosure when their loans matured. Okay, they hit the maturity wall, and they were unable to refinance. And the reason why is number one, because of the high interest rates and the low NOI, net operating income. The reason why the NOI dropped is because guess what? Inflation hit them. Property taxes went up, insurance went up, labor went up, everything went up. So their income stayed stable, but their expenses went way up, crushing their NOI. So combine that with the high interest rates, no loan. Okay? All right, so that's what happened. Now, let me share with you mathematically how all this works out so you can get a better understanding. Let's do that next. Here is the second part of why it's happening. This is the math part. This is the fun stuff. And if you can understand this, this will help you understand once we get to the opportunity part. Okay? All right, let's get started. All right, here's why it's happening. I'm going to use Aspen Apartments as an example. So this is in the year 2020. Okay, so the income for Aspen Apartments was about $24,000 per month or $288,000 per year. Okay, the expenses, I'll take the expenses to be 40% of the income. So it's about $110,000 a year. Okay, so income minus expenses equals your NOI, $172,000 per year. Okay, and then to calculate my cash flow, I'm going to subtract my mortgage from my NOI. My mortgage is $114,000 per year. Here's how I calculate that. Okay, so I have a mortgage balance of $2 million. At 3% interest rate, it equals $9,500 a month. All right, so I take that monthly figure, multiply it by 12 months, and it gives me my $114,000 per year. Okay, now, if you can take your NOI minus your mortgage, it equals your cash flow. So I'm positive $58,000 per year. Okay, all right, now, fast forward 5 years later, the same property, okay, Aspen Apartments, in 2025. Now my loan says by the fifth year, the loan matures and I have to get out. I have to refinance, sell it, or get, somehow pay the bank off. Okay, so in 2025, my income did go up. See, in 2020 it was 24,000. In 2025, the rents actually went up. Okay, it's about $336,000 per year. But also, guess what else went up? Expenses went up. As you all know, inflation, right, clobbered a lot of this with the higher insurance, that's for sure, higher utilities, labor costs, supplies, materials, everything shot up. Okay, so the expenses went up here too. All right, and so 4 years ago it was 110. This year's 168, 5 years later. So everyone's experiencing that. Okay, so income minus expenses equal to NOI. Now look at this. So back in 2020, I had an NOI of 172,000. 5 years later, guess what? My NOI is lower. Even though I had higher income, I had much higher expenses. That happens to everyone across the board. And that's what happened to the last two examples I gave you. Okay, so the NOI minus your mortgage equals your cash flow. I'm negative here. Here's how I calculate the mortgage. Okay, same loan balance, keep it simple, $2 million. At 7%, 7% interest rate, the mortgage payments are $14,000 per month. Okay, here at 3% is $9,500 a month. Here with the higher interest rate is $14,000 a month. right? So you get your NOI minus your higher mortgage, it equals negative $2,000 per year. So negative cash flow. So here's the bottom line, okay? In 2025, Aspen Apartments will not qualify for refinance because of the higher interest rate, right? And the lower NOI. Okay, so that's why it's happening. This is happening across the country. And guess what? And the next from this from today on, the next 4 years, that ticking time bomb of $1.5 trillion, you're going to see a lot more of this. Got it? Next, what I wanted to share with you where the opportunity is for you. Let's do that next. Got questions? Simply text the word Peter to 833-942-4516 and we'll help you. Here we are with the opportunity now that you have all of this understanding and knowledge under your belt. And what I'm going to share is not rocket science. These are things that you can do now. In fact, I challenge you to make this your 2025 goal, right? Is to put this into effect. All right, now let me share with you, for the sake of brevity and keep the video short, I'm going to focus on one sector only, and that's the multifamily sector, okay? All right, even though the other ones, you have just as much opportunity, I would choose as one sector. The how-to is the same. All right, the multifamily sector, as I mentioned before, for 2025, this upcoming year, there is going to be about $257 billion in loans maturing, okay, in 2025 over about 6,800 properties. So there's almost 7,000 multifamily properties that have loans on them in the order of $257 billion, okay? That's coming due in 2025. So massive opportunity for you if you play it right. Some of these properties over this loan here, some will be able to refinance successfully. Okay, they'll be able to do that. Secondly, some of them will just sell outright and just sell their property and be gone. Okay, so those are, for some, those are options. Okay, but the opportunities are lying in these next two. Okay, number three, the others or some will work it out with the bank and extend the loan. And I've seen this in 2024. That has happened quite a bit. So remember, lenders, they don't want their property back. So if you give them a good plan, sometimes they will give you a loan extension so you can work it out and put the property in better position to get it refinanced down the road. Okay, so some will work it out with the bank and extend the loan. Okay, and the others, some will be headed towards loan default and foreclosure. So these two guys, 3 and 4, this is where the opportunity lies. Now here's what you do. Okay, number one is I want you to locate maturing loans and contact the borrowers. I need you to think win-win. You are not taking advantage of anyone here. Okay, you're locating loans that are maturing in the next 1 or 2 years, and you're going to contact the people who borrowed the money directly. You can do that through county records and third-party software. Okay, it's not difficult at all. Number two is I want you to engage with these borrowers, okay, because they are motivated. How many times have you heard me say that this business, the commercial real estate business, is a relationship-based business, always will be. So the more you get to build a relationship with the sellers and the property owners, the closer you are to getting a deal done. Okay, it's not how much money you have or what school you went to. It's your ability to create and nurture relationships over time. Okay. All right. Number three, after you find who these borrowers are that are motivated, you're going to engage with them. You need to get basic deal information from them. Okay. Basic, for example, a profit and loss statements for the last 12 months, rent rolls. So you have basic information so you can do a full analysis. Okay. This is what we need to get from our students when they have a deal like this. We ask them to get 12 months of income expense statements and a rent roll. Then we can go at it and help them structure the deal. Same to you. Okay. Number four is to have your capital ready. Have your capital ready to deploy. Okay. So have your ducks in a row, finances wise, money wise, so you can jump on these opportunities. And if you don't, I have a big or here, or what you can do is you may need to do something creative. like creative financing, which I believe our company is the best at. Okay, so you can do a master lease, you can do all the different things you can do here to work with these types of sellers. Okay, your end goal, okay, end goal is to get these two categories out of their loan, okay, or to do some form of creative financing. All right, so when you have someone who just worked it out with the bank and the bank gave them an extension, guess what? They're still distressed. They still need help. They may need a financial partner like you to do something creative to help them get over the hump. Okay, so like a master lease or some form of other seller financing may work out for these two categories. Okay, especially these guys need help right away. All right, so but your bottom line, what you want to do here is if you take over their property, is you want to increase the rents, you want to control and optimize expenses, and you want to increase the NOI. Why I'm saying that is in 2025, this is the year of the NOI. Okay, I want you to focus on cash flow and not appreciation. When you focus on cash flow, cash flow, cash flow, guess what happens? Your operations get better, your income gets better, your expenses are controlled, and guess what? Your property value tends to increase. Okay, so think cash flow first, and appreciation will naturally come later. All right, so if you can increase your rents, control your expenses, get the NOI at least stabilizing, going upward over time, you're going to position the property for the best loan possible. Okay, so that's the goal here. That's the goal here, to help out these two categories. Okay, so I showed you where the opportunities are, how to find them, what to do, and the mindset that's needed to be successful here. All right, now, is this your goal for 2025? I know for a lot of my students it is, because this is opportunities to be had right now. All right. Thank you everyone for hanging out with me this long. If you did so, if you're still here, you are my favorites. So if you want to learn more about commercial real estate, click on the link. You can read a book and get at it. If you want to do what our students are doing this year, go ahead and click on the link and apply to be a mentee of ours. Thank you everyone so much. Have a great 2025, and I'll see you at the next video.